Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. And today's question comes from Ron of Milwaukie, Oregon. Alan, will you enter a position when the market is in general decline or when the futures are down and you know that the market will gap down at open? In other words, will you enter a position overnight or wait until the market has opened and stabilized? Well, Ron, it looks like you've asked actually two very important questions here. The first one is, will we enter a covered call position when the market is in general decline? The answer is, almost always I'm fully invested in the covered call portion of my portfolio. Now, there are aberrations as took place in 2008. So if we take a look at a 5-year chart of the S&P 500, I've indicated for you with the red arrows the times when I was actually out of the market due to a market decline. And again, that was during the recession of 2008. And as you can see from the chart, I exited in the latter part of the year and re-entered early in 2009 when the uptrend started. Now, during the normal whipsaws of the market, when we have a bearish environment or a volatile environment, there are certain things that we could do to mitigate these situations. And I've listed them for you on the chart on the screen. 1, we could use low beta stocks. Low beta stocks are stocks with low volatility as compared to the market benchmark, the S&P 500. And these equities tend to outperform in bearish market environments. We can also use exchange-traded funds. These also have lower volatility than equities in general because they represent baskets of stocks. And finally, and probably most importantly, we could use in-the-money strikes. In other words, we can gain additional downside protection that is paid for by the option buyer. So these are 3 very good tactics we could use in bearish market environments. Now, the second part of your question is, when is the best time to enter a covered call trade? And I have found over the years that the sweet spot for me is anywhere from 11 a.m. to 3 p.m. Eastern Standard Time. That's when the market has the least amount of volatility. You avoid the early market, pre-market news, the institutional computerized trading that takes place early and late in the day. So again, 11 a.m. to 3 p.m. is when I would advise entering your covered call positions. And finally, I would never ever enter a covered call trade overnight because so much can happen prior to the execution of that trade. So Ron, thanks so much for that wonderful question, and to all of our viewers for watching this video. I hope you found it useful. This is Ellman, the Blue Collar Investor. Take care, everybody.